Structural tension. The halt. That wasn't about price was not at historic highs. Volatility was not at crisis extremes. There was no headline shock, no geopolitical rupture, no sudden macro surprise. And yet, trading was halted. On the surface, the explanation is straightforward. A technical pause, risk controls functioning as designed, circuit breakers doing their job. Exchanges exist to maintain orderly markets. Temporary halts are part of that architecture. Nothing unusual, nothing dramatic. But beneath that surface, calm, timing matters. The halt occurred near a delivery window. Spreads had been tightening. Vault reports showed subtle shifts. Open interest remained concentrated where it typically begins to thin. None of these signals individually demand attention. Together they create tension. Halts rarely occur because price is high. They occur because price is moving fast. Exchanges can absorb gradual repricing. What becomes destabilizing is velocity, particularly when that velocity intersects with delivery cycles. Paper contracts represent multiples of the physical metal available for immediate delivery. Most of the time, that imbalance is manageable because contracts are rolled, offset, or cash settled. But when open interest clusters near first notice day while registered inventory remains finite, structural fragility increases. This is not accusation. It is arithmetic. If claims expand while deliverable supply stays constant, stress accumulates quietly. The data is public. The reports are verifiable. And before forming conclusions, we need to examine that plumbing directly. What just happened? Event breakdown and immediate context. The halt occurred mid-session, minutes after a sharp acceleration in price that pushed silver through a well-defined intraday range. Price was not at multi-year highs. It was trading within a broader consolidation band. What changed was the speed of the move. Volume expanded rapidly in the minutes preceding the pause, with a visible spike in front-month contracts. The timing was notable. The halt came just days before first notice day for the active delivery month. Open interest in that front-month contract had not yet collapsed to typical pre-delivery levels. Public exchange data showed a meaningful number of contracts still open relative to recent delivery trends. Spread behavior added context. The front month to next month spread had been tightening into the move. Not extreme backwardation, but compression relative to prior sessions. That matters because spreads often reflect immediate demand pressure more clearly than outright price. Vault reports in the days leading up to the halt showed incremental adjustments. Registered inventory was stable but not expanding. Eligible metal remained larger in headline terms, yet not all eligible is automatically deliverable. There were no dramatic outflows that day, but the broader trend had not been aggressively rebuilding stocks either. Block trade reporting also increased during the session. That is not unusual during volatile windows. But when large negotiated trades cluster near delivery periods, it adds another layer of complexity. Why does this matter? Trading halts reset momentum. They interrupt order flow and give liquidity providers time to recalibrate. During ordinary periods, that function is routine. During delivery windows, momentum carries different implications. A fast repricing move can force decisions, roll, offset, or stand for delivery. This is where inventory ratios become relevant. Each futures contract represents 5,000 ounces. Multiply total open interest by that figure and you get paper claims outstanding. Compare that to registered inventory, the metal specifically designated for delivery. The ratio between those two figures is commonly referred to as the cover ratio. A high cover ratio does not mean default. Most contracts are closed or rolled. But when open interest remains elevated close to first notice day and registered stocks are finite, velocity becomes more sensitive. The exchange has provided its explanation. The data is public. Before drawing conclusions, the structural math deserves a closer look. The plumbing, open interest, registered inventory, and pressure math. To understand whether a halt reflects routine volatility or structural strain, we have to move beneath price and into plumbing. Open interest represents the total number of outstanding futures contracts that have not been closed or delivered. Each silver contract controls 5,000 ounces. If open interest sits at 150,000 contracts, that represents 750 million ounces of paper claims. That figure alone is not alarming. Futures markets are designed for leverage and hedging. The system functions because most contracts are offset before delivery. The stress question emerges when we compare those claims to registered inventory. COMEX vault metal is divided into two primary categories, eligible and registered. Eligible silver meets exchange specifications for purity and bar size. It is approved for storage within exchange vaults. But eligible metal is owned by private parties and is not automatically available for delivery against futures contracts. Registered silver, by contrast, has been specifically designated as deliverable supply. It carries a warrant, meaning it can be assigned to satisfy a futures contract obligation. The distinction matters. Eligible inventory can become registered, but only at the discretion of the owner. Conversion requires consent. It is not automatic liquidity. This is where scarcity math begins. If total open interest represents 750 million ounces and registered inventory stands at 90 million ounces, the cover ratio is 750 divided by 90, or roughly 8.3 to 1. That means for every ounce registered for delivery, there are more than 8 ounces of paper claims outstanding. Again, this is not evidence of default risk. The vast majority of contracts will roll or offset. But when that ratio remains elevated into first notice day, sensitivity increases. The system depends on behavior patterns continuing as expected. Vault flow trends add nuance. Over recent months, registered stocks have fluctuated within a defined range rather than expanding decisively. Inflows occur, but large sustained rebuilds have been limited. During prior delivery cycles, modest drawdowns into notice periods have been common. That pattern is manageable as long as new metal enters the system afterward. Delivery notices provide additional context. When contracts stand for delivery, warrants are transferred. If delivery volume approaches the lower end of registered stocks without rapid replenishment, attention increases. Not because failure is imminent, but because flexibility narrows. Spread behavior often reveals that narrowing flexibility before headline price does. A tightening front-month spread relative to deferred contracts can signal immediate demand for nearby supply. Backwardation, where near-month trades above deferred, historically appears during periods of localized tightness. Even mild backwardation near delivery windows deserves monitoring. Volatility metrics reinforce this dynamic. Implied volatility frequently clusters around roll periods. As traders decide whether to stand or roll, option pricing reflects uncertainty. Elevated implied volatility is not abnormal in metals, but when it rises alongside spread compression and stable or declining registered stocks, it suggests traders are pricing distribution tails more carefully. Exchange enforcement actions are another variable. Position limits exist to prevent concentration. Margin requirements can be adjusted when volatility accelerates. Liquidity providers widen spreads when risk rises. None of these measures imply manipulation. They are stabilizing tools. But when they activate near-delivery clusters, they confirm that stress is being monitored. Structural pressure does not announce itself with a siren. It develops incrementally. Registered stocks plateau instead of expand. Spreads narrow quietly. Open interest lingers longer than usual in the front month. Implied volatility creeps higher. Each component alone is benign. Together, they form a mosaic. This is where informed participants separate from reactive ones. The data does not promise rupture. It does not guarantee repricing. What it shows is conditional fragility, a system that functions smoothly as long as behavioral norms hold. The halt did not occur in isolation from this backdrop. It occurred against arithmetic. And to understand whether arithmetic becomes resolution or simply resets, we have to examine why these disconnects exist in the first place. Why disconnects exist? Structural mechanics. Explained. At first glance, it seems contradictory that signs of physical tightness can emerge while price remains contained. If supply is constrained, shouldn't price immediately reflect that scarcity? In a purely physical market, perhaps. In a derivatives-dominated market, the mechanics are more layered. Futures contracts are primarily hedging instruments. Producers hedge output. Fabricators hedge input costs. Funds express directional views. The vast majority of contracts are never intended for physical delivery. They are financial tools designed to transfer price risk without transferring metal. This structure allows paper claims to exceed registered inventory by multiples. It functions because behavior is predictable. Participants roll forward into the next contract month. They offset before first notice day. They settle financially rather than physically. Cash settlement options further dampen immediate strain. While COMEX is a physically deliverable market, financial offsets dominate. If counterparties agree, exposure can be neutralized without a truck ever moving metal. Roll behavior is critical. As delivery approaches, Speculative positions typically migrate into deferred months. That migration reduces front-month open interest and relieves delivery pressure. As long as that cycle continues smoothly, elevated cover ratios are manageable. Our history reinforces this pattern. In 2008, during the broader liquidity crisis, metals spreads distorted sharply before price fully reflected stress. Liquidity tightened first. In 2011, silver's rapid ascent toward $50 was preceded by volatility expansion and margin adjustments that forced deleveraging. In 2020, pandemic disruptions created temporary dislocations between futures and physical markets, resolved not by collapse, but by logistical recalibration. What tends to break first in stress cycles is not the metal supply itself, it is liquidity. Bid-ask spreads widen, volatility accelerates, margin requirements increase to control leverage. These responses are mechanisms of containment. Trading halts sit within that containment framework. Circuit breakers are designed to pause order flow during rapid repricing. They are not admissions of failure. They are structural tools to prevent disorderly cascades. In some cases, they protect traders from extreme slippage. In others, they protect the integrity of clearing systems by slowing momentum. It is important to separate structural fragility from inevitability. A high cover ratio does not predict default. Tight spreads do not guarantee backwardation escalation. Delivery clusters do not ensure shortage. Stress can dissipate quietly. A few large longs may roll forward. Registered inventory may be replenished through warrant conversion. Spreads may widen as liquidity providers regain balance. The purpose of examining these mechanics is not to imply conspiracy. It is to understand incentives and constraints. Exchanges are designed to maintain continuity. Participants are motivated to avoid forced delivery when alternatives exist. But incentives have limits. When multiple stress indicators converge, tight spreads, stable or declining registered stocks, elevated volatility near delivery windows, the system becomes more sensitive to velocity. That sensitivity does not declare outcome. It defines risk boundaries, and those boundaries narrow most clearly during specific calendar windows, where timing, not price level, becomes the dominant variable. Countdown, delivery and roll. Window pressure structure becomes most visible when the calendar tightens. First notice day marks the point at which long holders of a futures contract can be assigned delivery. Any participant still holding a front-month contract at that moment is signaling the capacity, or intention, to take metal. Last trading day follows shortly after, closing the window for offsetting positions. Between those dates lies the roll window, where most speculative and hedge fund participants migrate exposure into deferred months. Under normal conditions, this transition is orderly. Open interest declines steadily into first notice day as non-delivery participants exit or roll. The system breathes out. Pressure dissipates before it accumulates. Stress emerges when that decline stalls. If open interest remains elevated close to first notice day while registered inventory is stable or thin, optionality narrows. If, at the same time, front-month spreads compress relative to deferred contracts, the signal shifts from passive rolling to potential standing. That does not imply mass delivery demand. It implies sensitivity. Once first notice day passes, delivery notices begin to be issued. Shorts assigned must deliver registered warrants. Metal does not necessarily leave the vault immediately, but ownership transfers. If delivery notices accumulate rapidly relative to available registered stocks, attention intensifies. The settlement cycle unfolds over days, not minutes. That duration is critical. It allows for adjustments, warrant conversions, vault inflows, negotiated offsets. The system has buffers. Short-term catalysts can influence how this window behaves. A sudden dollar spike can pressure leveraged longs to roll defensively. Margin requirement changes can accelerate liquidation. A large vault inflow into registered can ease concern quickly. Conversely, spread inversion near delivery amplifies focus. None of these variables guarantee escalation, but delivery cycles cluster decision points into compressed time frames. When arithmetic meets timing, velocity matters more than price level. That is why halts near these windows deserve scrutiny, not as proof of failure, but as markers of sensitivity within a countdown defined by structure. Macro overlay. Bigger forces moving beneath. Structural stress inside a futures market does not operate in isolation. It interacts with macro liquidity, currency trends, and sovereign behavior. Start with the dollar index. A strong dollar typically suppresses nominal metals prices, particularly in Western trading sessions. Dollar strength tightens global financial conditions and pressures commodity pricing in dollar terms. Yet paradoxically, sustained dollar strength can coincide with increased physical demand abroad, especially in regions seeking currency diversification. Price weakness in dollars can translate into strategic accumulation elsewhere. Federal Reserve policy deepens that dynamic. Nominal rates matter, but real rates, rates adjusted for inflation, carry more influence over metals allocation. When real yields rise, non-yielding assets face headwinds. When liquidity contracts through quantitative tightening or restrictive credit conditions, leverage unwinds across risk assets. Metals can consolidate during those phases, even as underlying structural pressures quietly build. Oil adds another layer. Energy represents a significant component of mining costs. Sustained oil strength compresses margins for producers unless metals prices adjust upward. At the same time, elevated energy prices reinforce inflation psychology, encouraging periodic hard asset allocation. Geopolitics operates beneath these economic variables. Sovereign diversification away from concentrated reserve exposure has accelerated in recent years. Central bank gold accumulation trends are well documented in public data releases. While gold remains the primary reserve asset, spillover sentiment influences broader precious metals positioning, including silver as both monetary and industrial hybrid. The inflation backdrop further complicates interpretation. If inflation proves sticky rather than transitory, capital allocation cycles may rotate gradually back toward tangible assets. If inflation moderates decisively, real rates could remain elevated, tempering immediate enthusiasm. Metals tend to move most decisively when macro liquidity aligns with structural tightness. A delivery-sensitive futures market paired with easing financial conditions creates one set of probabilities. Tight liquidity paired with modest inventory stress creates another. Understanding which macro regime is dominant reframes the significance of any single trading halt. And once macro context is layered onto structural math, scenario framing becomes the next logical step. The bull case. Structural resolution higher. The bullish case does not require drama. It requires alignment. If front-month spreads remain persistently tight into successive delivery cycles, that suggests nearby demand is not fully dissipating through routine rolls. If registered inventory trends gradually lower across quarters rather than rebuilding decisively, the margin for flexibility narrows incrementally. If open interest remains resilient instead of collapsing during volatility events, participation is not fleeing the structure. Layer macro onto that foundation. If real rates stabilize or begin easing while liquidity conditions improve, capital rotation into hard assets becomes more probable. Sovereign accumulation trends, particularly in gold, reinforce a broader diversification theme that can spill into silver positioning over time. When trading halts cluster around delivery windows rather than isolated price spikes, it can signal that velocity near settlement dates is more sensitive than headline price suggests. Sensitivity does not equal failure. It implies fragility. In that environment, resolution higher tends to unfold as a process. Spreads invert more frequently. Backwardation appears episodically. Volatility expands upward rather than downward. Price reprices in stages as structural tightness meets improving liquidity. This is not an overnight event. It is a multi-month transition from compression to expansion. The bullish thesis rests on arithmetic sustaining pressure long enough for macro conditions to align, gradually converting fragility into repricing the bear case. Pressure dissipates quietly. The bearish case is less dramatic, but structurally plausible. If large speculative longs continue rolling forward rather than standing for delivery, front-month open interest will decline in line with historical norms. Pressure near first notice day would ease without incident. If vault inflows increase, particularly into registered category, cover ratios improve mechanically. Optionality expands. Fragility diminishes. A strengthening dollar adds further headwind. Sustained dollar appreciation tightens global liquidity and discourages leveraged commodity positioning. If real rates remain firm, capital may prefer yield-bearing instruments over metals exposure. At the same time, industrial demand for silver could soften if global growth moderates, reducing fabrication pressure on physical flows. In that scenario, trading halts look procedural rather than structural. Circuit breakers respond to velocity, not shortage. Spread compression resolves as deferred contracts regain premium. Backwardation fails to persist. Volatility mean reverts instead of expanding. Price then consolidates within established ranges. Speculative enthusiasm fades. Inventory metrics stabilize or rebuild gradually. The system demonstrates resilience rather than rupture. This outcome does not invalidate concerns about cover ratios or delivery math. It simply shows that stress can normalize through routine adjustments. Intellectual honesty requires acknowledging that arithmetic sensitivity does not guarantee escalation. Sometimes pressure dissipates quietly, leaving structure intact and price unchanged. Data compression, what actually matters. Strip away commentary and focus on the measurable signals. Open interest relative to registered inventory defines the cover ratio and delivery sensitivity. Front-month spread behavior reveals immediate demand pressure. Vault flow trends show whether registered stocks are rebuilding or plateauing. Delivery notice counts indicate how many contracts are actually standing. Implied volatility clustering near roll windows reflects distribution risk. Roll window timing compresses decisions into defined calendar stress points. Macro real rate trends determine whether liquidity supports or suppresses metals allocation. These are the structural variables. Everything else, headlines, reactions, commentary, sits on top of this arithmetic foundation. Disciplined close. This is education, not prediction. Patience matters more than panic. Verify the reports, study the inventory, track the spreads. Trading halts do not prove collapse, but they can signal sensitivity. Control emotion. Let structure, timing, and arithmetic, not headlines, shape your decisions.